The first quarter of 2022 has now come to a close. Let's talk about what moved markets and how we have things positioned for our clients going into the next quarter. So much has changed over the last quarter. The S&P 500 fell almost 13% through early March, then rallied 11% 3 weeks later. We had the tragic war still ongoing in Ukraine, global energy shock, increasing inflation, labor market strength, and a lot of central bank talk around interest rates. So let's break each one of these down. Russia's invasion of Ukraine has taken a horrible human toll and really driven a spike in both food and energy insecurity, which has created a price bump in commodities. And as a result, this has dampened economic growth and really exacerbated a lot of already existing supply-driven inflation. Europe is most immediately exposed to the repercussions of this conflict, not only by geological proximity, but also their dependency on Russian oil. So while they attempt to wean themselves off of that Russian oil, by comparison, the U.S. economy appears to be, on a relative basis, more resilient. As far as interest rates and inflation, last week, bond yields sprinted higher with the 10-year U.S. Treasury hitting now a 3-year high. Then earlier in the quarter, the Federal Reserve hiked rates for the first time since 2018. Now that said, we believe this could be a short-term pain, long-term gain type of scenario for bonds, as any of the new bonds being issued are going to start to be issued at higher rates. So the Federal Reserve's job really is essentially to keep the economy either from running too hot or from running too cold. And right now, the best way to cool off these hot inflation numbers we're seeing is for the Federal Reserve to start to bump interest rates. Now, if they slam on the brakes too hard, this could cause a recession. On the other hand, if the Fed isn't aggressive enough, the markets, they can essentially lose confidence that the central banks are going to be able to put a lid on inflation eventually here. Now, all this means is there's definitely some short-term downside risk for the longer-dated bonds in a portfolio. And essentially, you'll have to hold those bonds at a lower rate for longer. And what the Fed's going to do is be watching key numbers around employment to dictate a lot of this going forward, is how aggressive they should be. We do expect a post-Omicron boost on the employment numbers. And essentially, we believe the Federal Reserve is going to deliver on those projected increase through the remainder of this year, but then take a pause as more data comes to light. So while inflation, interest rates, Ukraine, they're all top of mind right now, let's not forget that the labor market is, by all measures, on fire right now. So let's take a look at a few charts here by one of my favorite financial publicists, Ben Carlson. The unemployment rate, as we can see on the chart, is essentially back to pre-pandemic levels at 3.6%. The lowest unemployment has ever gotten in modern economic times was 2.5%, as you can see on the chart. We added about 1.7 million new jobs just in the first 3 months of this year alone. So the question is, with the labor market this strong, is it possible that the current recovery continues for years to come? Well, as with anything related to the economy and stock market, bond market, it's never that simple. So while this is only one data point, it's definitely one that'll be at the top of the stack at each Federal Reserve meeting this year. Now, historically, one of the best hedges against rising inflation is to own equities. Owning stock in companies that can immediately pass on any rising costs to their end customer. So here's a perfect example. In December, Chipotle hiked their prices another 4%. This made essentially their prices over the last 12 months about 10% higher, than the year prior. And their CEO told the Wall Street Journal last month that they could raise prices a few more times this year, if needed, without projecting demand to fall off. Meaning, hey, we think we could bump our prices a couple more times and still sell the same amount of burritos. So if you own shares in the business of Chipotle, you were a direct beneficiary of those price hikes. Now, does every business function exactly like this? Well, no. But I think it's a great example of how owning stocks, if you can stomach, that short-term volatility in price, can be a great hedge against long-term inflation. So, going into this next quarter, we now prefer U.S. equities over Europe, really due to that energy shock and ongoing conflict still, and we will stay underweight on a relative basis to any longer dated bonds in the portfolio because of this inflationary backdrop. So those would be our two preferences going into the second quarter of this year, and obviously subject to change and should not be relied on as financial advice, investment advice for those viewing this video. With that said, if you are a client of BWM and you'd like to jump into the weeds and discuss any details as far as changes that were made over the last portfolio and specifically how you're positioned, please don't hesitate to reach out. As always, stay the course and stay on point. Take care.